Understanding Jensen's measure, a key metric in portfolio management. Investing in financial markets involves a careful analysis of potential returns against associated risks. One key tool that helps investors and analysts evaluate portfolio performance is Jensen's measure, or Jensen's alpha. This metric enables investors to determine how well a portfolio is performing compared to a benchmark index while accounting for the risks involved. Below, we dive deeper into Jensen's measure, its formula, implications, and some criticism surrounding it. What is Jensen's measure? Jensen's alpha is a performance measurement developed by economist Michael Jensen in 1968. It is primarily used to gauge the excess return an investment portfolio generates over the expected return as determined by the Capital Asset Pricing Model, CAPM. Essentially, it measures the abnormal or excess returns of an asset relative to its expected returns, making it a fundamental concept in investment analysis. In simplified terms, Jensen's measure underscores the difference between an investor's portfolio returns and the broader market's performance. A positive alpha indicates that the portfolio has outperformed the market when risk is accounted for, while a negative alpha signals underperformance. This calculation is crucial for portfolio managers aiming to demonstrate their ability to generate returns above what might be expected based on the portfolio's systematic risk. Key components of Jensen's measure. Jensen's alpha is documented as follows. Formula. The formula to calculate Jensen's alpha is \text alpha equals R(I)(R)(F) plus B times R(M)(R)(F). Where R(I) equals the realized return of the portfolio or investment. R(M) equals the realized return of the market index. R(F) equals the risk-free rate of return for the period. B equals the beta of the investment portfolio in relation to the chosen market index. Interpretation of results. The value derived from applying the above formula can result in three distinct outcomes. Positive alpha indicates that the asset outperformed the benchmark index, delivering excess returns. Negative alpha signifies that the asset underperformed in comparison to the benchmark, suggesting poor performance relative to risk. Zero alpha reflects a neutral position where the asset's return aligns with the expected market return, suggesting efficiency in the market. Practical application of Jensen's measure. Investors utilize Jensen's measure to not only assess numerous assets across various classes, such as stocks, bonds, or entire portfolios, but also to evaluate the performance of fund managers. For instance, if two mutual funds return 12%, but one carries a higher risk profile, rational investors would likely prefer the fund that achieves a similar return with less risk. In investment management, showcasing a positive Jensen's alpha is seen as a significant indicator of a fund manager's skill. It implies that the manager has excelled in selecting investments or timing the market effectively, thus offering additional value to investors. Example. Consider a mutual fund that achieved a realized return of 15%, a market index return of 12%, a beta of 1.2, and a risk-free rate of 3%. The calculation of Jensen's alpha would yield \text alpha equals 15%, 3% plus 1.2 times 12%, 3% equals 15%, 13.8% equals 1.2%. This positive alpha indicates that the fund outperformed its expected returns given the level of risk accepted. Criticism of Jensen's measure. While Jensen's measure is a valuable tool, it has faced scrutiny, particularly from proponents of the efficient market hypothesis, EMH, articulated by Eugene Fama. EMH suggests that all available information is already reflected in asset prices, meaning it is nearly impossible to consistently achieve excess returns through skill alone. Critics argue that Jensen's alpha can sometimes misrepresent the abilities of active managers when excess returns are rather due to luck or randomness rather than any discernible skill. Studies showing that many active managers fail to outperform passive index funds bolster the EMH stance, providing an ongoing debate in investment circles. Conclusion: Jensen's measure, or alpha, is undeniably a cornerstone of investment analysis, providing critical insights into an asset's performance relative to risk. It helps investors make informed decisions by quantifying the excess returns generated over expected outcomes. However, potential users should remain mindful of its limitations and the ongoing discussions surrounding market efficiency and skill versus luck in investment success. Incorporating Jensen's alpha into a wider investment strategy can enhance portfolio management, yet thorough due diligence remains paramount in making sound financial decisions. As with all metrics, it should be one of several tools utilized to assess investment opportunities.